Defensive tone to the market, utilities, real estate moving. Take a look at sectors. Energy, oil's over $70. I heard the guys talking about that. That's on the upside. But elsewhere, we've got dollar strength the last couple of days. This is trade related. And whenever that happens, the usual stuff moves down. Metals and mining stocks down 2%. Emerging markets down 2%. That's China Internet, the third one there. That's down 2%. This happens every time you get dollar strength, trade issues kind of floating around here. Elsewhere, the market direction, well, you know, the usual stories over the weekend about sell in September. Yes, it's the worst month on average. It's down 0.5% since 1950. None of this impresses me in the least. Look, it's been up 29 times and down 37 since 1950. That's about 40% up, 60% down. That's not enough to panic about. And have you noticed all these old chestnuts we keep bringing up? Doesn't anyone notice they don't work anymore? Sell in May and go away. We've been up almost 10% since then. The midterm presidential cycle, the two quarters, second and third quarter in the midterm presidential cycle, very reliably down. Really good indicator. Wrong this year. Really wrong. Down almost 10%. We'll see if that happens. It changes in September, but I'd be quite surprised overall. So don't get too concerned about whether September is an up or down month. There's issues out there for the month, though. The U.S. markets have clearly been moving with trade issues, so some resolution on NAFTA and China would be helpful. There's once again the peak earnings and margins debate all over. Now it's peak earnings for the third quarter. It was peak earnings for the first quarter 6 months ago. And there was some concern about slowdown in the U.S. growth here. But the big debate, and this has been going on for a long time, is about this weird disparity with the United States versus the world overall. There's been good reasons why the U.S. has been outperforming. We have superior growth. We have corporate tax cuts. We have this astonishing run in the super cap tech growth areas in Apple and Amazon and Microsoft and NVIDIA and some of these amazing semiconductor stocks. So there's a good reason we've been outperforming, but it is a little weird. The numbers, S&P up 8.5%. The world ex-United States, you can buy this as an ETF now. This is one of the iShares ETFs, down 4.9. We're talking about a 13% difference between the U.S. and the rest of the world generically. Germany has been terrible in general. Europe has been underperforming 4, 5, 6% throughout the year. Japan is essentially flat, and we know what a basket chase China has. Many of those markets, they're retail driven, and many of the retail investors there are concerned about the trade war overall. So a lot of weird disparities this year, and a lot of people have noticed this. Morgan Stanley, the guys over there, just out with a note this morning, they were overweight the United States. Now they are neutral, and they specifically talked about this weird outperformance, that it's time to spend a little more time in Europe. Overweight 2% there. They're changing that. Japan and emerging markets, still not sure they should do anything there. They're essentially still underweight. The point is, a lot of people talking about maybe Europe would be worth looking at with all of the declines this year. Back to you guys.